Welcome back to Mastering MBA. In today's lesson, we are diving into one of the most powerful yet misunderstood financial statements, the statement of cash flows. If the income statement tells the story of profitability, the cash flow statement tells the truth about liquidity, where money actually comes from and where it goes. Many profitable companies have failed not because they lacked income, but because they ran out of cash. So let's explore how this statement reveals the financial heartbeat of any business: purpose and importance. The statement of cash flows measures the actual movement of cash in and out of a company during an accounting period. It helps investors and analysts see whether profits are being translated into cash. This statement became essential after major financial collapses like W.T. Grant and Lehman Brothers, where companies reported strong earnings but had negative cash flow from operations. That's why this statement is so powerful. It separates accounting profit from economic reality. Cash versus income, the big difference. Here's the key principle: net income does not equal cash flow. Under accrual accounting, companies can report revenue before they receive cash or record expenses before paying them. For example, a company might show high sales on credit, boosting net income, but no cash has actually arrived. The cash flow statement adjusts for this, showing the real liquidity picture. It tells you whether a company can meet payroll, pay suppliers, and sustain growth without new borrowing. What the statement explains. Conceptually, the cash flow statement is simple. It explains the change in the cash account between two balance sheet dates. In other words, why did the cash balance increase or decrease this year? It's essentially a reorganization of changes in all other balance sheet accounts, showing how they affect cash. Section 2: Preparing the statement, the three activities: cash and cash equivalents. Cash includes currency on hand and short term, highly liquid investments with maturities of 3 months or less. The final line of the statement always reconciles to the change in this account. The three major sections. The cash flow statement is divided into three activities. First is operating activities, CFO, cash flows from day to day business operations. Second is investing activities, buying and selling long term assets or investments. Third is financing activities, borrowing, repaying debt, or transactions with owners. These three sections together explain every dollar that moved through the company. Cash inflows and outflows. Think of these rules like gravity for cash flow. Inflows, sources of cash, a decrease in assets or an increase in liabilities or equity. Outflows, uses of cash, an increase in assets or a decrease in liabilities or equity. In short, when you spend cash, it's an outflow. When you collect or borrow it, it's an inflow. Section 3: Cash flow from operations, CFO, direct versus indirect method. Companies can present cash flow from operations in one of two ways. Direct method lists actual cash received and paid from customers, suppliers, employees. It's clear but rarely used. Indirect method starts with net income and adjusts for non-cash items and working capital changes. This is the most common method and the one analysts focus on. Indirect method, step by step. Let's break it down. First, start with net income. This is your accrual-based profit from the income statement. Second, add back non-cash expenses. Depreciation, amortization, and depletion reduce income but not cash, so they're added back. Third, adjust for gains or losses on asset sales. Gains are subtracted since the full cash effect is shown under investing, and losses are added back. Fourth, adjust for changes in working capital. When we prepare the cash flow statement using the indirect method, one of the most important steps is adjusting for changes in working capital. That's the company's current assets and current liabilities. Here's how it works. If there's an increase in current assets, like accounts receivable or inventory, it means the company used cash. More receivables mean customers owe you money, and more inventory means cash is tied up in products that haven't been sold yet. So an increase in assets represents a use of cash. On the other hand, a decrease in current assets frees up cash. When you collect receivables or sell off inventory, that money flows back into the business, so it's a source of cash. Now let's look at liabilities. An increase in current liabilities, such as accounts payable, means the company held onto its cash longer, perhaps by delaying payments to suppliers. That's considered a source of cash because the business preserved liquidity. Finally, a decrease in current liabilities means the company paid off its short-term debts. That payment reduces cash, making it a use of cash. In short, increasing assets consumes cash. Decreasing assets releases cash. Increasing liabilities provides cash. Decreasing liabilities uses cash. Understanding these simple but powerful relationships helps you see how operations really affect a company's day-to-day cash position. Fifth account for other non-cash items. Deferred taxes or equity income not yet received in cash are adjusted. By the end, you have cash flow from operations, the purest measure of a firm's internal cash generating power. Why CFO matters. Cash flow from operations is the lifeblood of a company. It shows whether a business can fund itself from its own activities without borrowing or selling assets. Consistently negative CFO is a red flag. Lehman Brothers, for example, reported rising profits in its final years, but its operating cash flow was negative every year before it collapsed. When income and cash flow move in opposite directions, it's time to ask questions. Section 4, Investing and Financing Activities. Investing activities. Investing cash flows reflect how a company grows and reinvests. Outflows. Buying property, equipment, or long-term investments. Inflows. Selling those same assets or collecting on long-term loans. High capital spending can signal growth or a warning sign if it's not matched by strong cash from operations. Financing activities. These show how a company funds itself through debt and equity. Inflows, borrowing money or issuing stock. Outflows, repaying debt, repurchasing stock, or paying dividends. Strong financing inflows can fuel expansion, but heavy outflows might indicate large repayments or dividend commitments that could strain cash. Final reconciliation. At the very bottom of this statement of cash flows, everything comes together in one simple equation. Cash from operations plus cash from investing plus cash from financing equals the net change in cash. This final number explains exactly how much the company's cash balance increased or decreased during the period. If you compare it to the beginning and ending cash balances on the balance sheet, they should align perfectly. That's how the statement of cash flows reconciles all the company's financial activities, showing not just where the money came from, but where it went and how it changed over time. It's the ultimate checkpoint that connects operations, investment, and financing into one complete financial story. That change should tie directly the difference in the cash balance between this year's and last year's balance sheet. Section 5, Analyzing and Assessing Cash Flow. Interpreting cash flow from operations. CFO analysts focus on three questions. First, is the company generating positive cash from core operations? Second, are the inflows consistent year to year? Third, what's driving the changes, growth, efficiency, or accounting adjustments? A strong CFO means sustainable operations. A weak or volatile CFO might mean trouble ahead. Common size and trend analysis. Just like with income statements, analysts often common size the cash flow statement. They express each inflow or outflow as a percentage of total inflows or total outflows. This helps compare across time or between companies and identify whether the firm's internal cash is enough to fund its investments and obligations. Qualitative red flags. Numbers don't lie, but classifications can. Analysts look for manipulation tactics such as misclassification, recording operating expenses as capital expenditures to inflate CFO, a tactic used by WorldCom before its collapse. Working capital games, delaying payments to suppliers boosts CFO artificially. Selling receivables for quick cash inflates short-term liquidity. Non-recurring adjustments, including unusual items like one-time settlements or trading cash flows. True analysis means adjusting CFO for sustainability, not just what's reported free. Cash flow. FCF, the real test. Let's talk about one of the most important measures of financial health. Analysts often go a step further and calculate free cash flow, or FCF. It's defined by a simple formula. Free cash flow equals cash flow from operations minus capital expenditures. This tells us how much cash the company has left after maintaining or expanding its assets. If free cash flow is positive, it means the business is generating enough money to pay dividends, reduce debt, or invest in new opportunities. If it's negative, it might be investing heavily for growth or struggling to generate enough cash from its operations. In other words, free cash flow is the true measure of a company's financial flexibility, the cash it has left after taking care of the essentials. Free cash flow shows how much cash remains after maintaining or expanding assets, the amount available for dividends, debt reduction, or reinvestment. Positive FCF signals flexibility and financial health. Negative FCF isn't always bad. It can mean the company is investing heavily in future growth. In the long run, however, consistent positive FCF is the hallmark of a financially strong organization. The bigger picture, the cash flow statement ties the entire financial picture together. The income statement shows profitability. The balance sheet shows position. The cash flow statement shows liquidity. Together, they reveal whether a company is profitable, stable, and self sustaining. That's why understanding cash flow isn't just for accountants, it's for every future healthcare and business leader. Cash flow tells the real story behind a company's earnings. While income statements can be influenced by accounting choices, cash flow reveals what truly happened, the actual movement of money in and out of the business. The cash flow from operations, or CFO, is the heartbeat of financial health. It shows whether a company's core operations generate enough cash to sustain growth, pay debts, and reward shareholders without relying on outside financing. When you analyze cash flow, don't just look at one year. Examine patterns over time, check for sustainability, and stay alert for signs of manipulation like sudden jumps in working capital or insistent capital spending. Finally, free cash flow, or FCF, represents true flexibility. It's the cash left after maintaining and expanding the asset base, the amount available for dividends, debt reduction, or reinvestment. In short, profit is an opinion, but cash flow is fact. CFO reveals strength, FCF defines freedom. Thanks for watching Chapter 4, The Statement of Cash Flows, Tracking Real Money. In our next video, we'll explore how to interpret and analyze ratios that use cash flow to measure performance and value. Content adapted from Fraser and Ormiston, 2023. Understanding Financial Statements, 12th edition. Pearson Education.